All right, let's get right into it. Welcome to This Explainer. I am absolutely thrilled to be taking you through today's topic because honestly, we've got a really fascinating journey ahead of us. Today, we're taking a macro to micro funnel approach to understand the Indian equity market as we look toward 2026. So we're going to start with a wide lens, looking at the mighty Nifty 50 index as a whole, and then we'll slowly zoom all the way in to dissect one specific, absolute champion of corporate efficiency, Nestle India. By the end of this, you're going to see exactly how big-picture market dynamics directly connect to the raw, fundamental numbers of a single outstanding company. Let's do this. Here is our game plan for today. First, we'll meet the Nifty 50, then explore the power of moats, decode some stock valuations, dive deep into corporate efficiency with our Nestle India case study, and wrap up with the 2026 equity market outlook. Section 1. Meet the Nifty 50, the pulse of India. Okay, so let's set the foundation. When we talk about the Nifty 50, we are literally talking about the undisputed heavyweights of the Indian corporate world. Launched back in 1996, this index is a carefully curated list of 50 of the largest, most liquid companies on the National Stock Exchange. And the methodology here is key. It's based on free float market capitalization. Basically, that just means it only counts the shares that are publicly available to trade, so it reflects true, active market value. The big takeaway for you here is that these 50 companies capture roughly 66% of the exchange's entire float-adjusted market cap. It is a beautifully diversified snapshot spread right across 13 core sectors. But not all 50 of these companies pull the same weight. Because it's a market-weighted index, the giants sitting at the very top dictate a massive portion of the whole market's movement. Just think about these top 3 heavyweights as of early 2026. HDFC Bank sits right on the throne with a massive 10.94% weightage. They're followed closely by Reliance Industries at 8.87% and ICICI Bank at 8.42%. When these specific blue-chip giants move, the whole market feels the ripple. Moving on to Section 2, the power of moats defending the castle. So how exactly do these massive companies maintain their leadership without getting eaten alive by competitors? Well, we have to funnel down into the qualitative side of things and talk about competitive moats. In investing, a moat is a sustainable advantage that protects a company, kind of like a literal moat protects a medieval castle. In the Indian market, we generally see 5 main forms. We've got brand moats, where companies can just command premium pricing without losing customers. We've got regulatory or license moats, think banking or telecom, where it's incredibly hard for a new player to even get permission to start. Then there are switching costs. For example, if a global corporation integrates an IT giant like TCS into their systems, ripping them out later is just way too expensive and risky. We also have cost advantages, where giants like Coal India or ONGC have unmatched scale or own natural resources. And finally, network effects, where a platform just gets more and more valuable as more people hop on board. Which brings us to our absolute focal point for today. Let's talk about Nestle India. Nestle possesses an absolutely incredible brand moat. We aren't just talking about name recognition here. It means consumers actively seek out their specific products on the shelves. They don't just want instant noodles, they want Maggi, right? Because of this unwavering consumer loyalty, Nestle enjoys an almost unshakable premium pricing power. It is nearly impossible for competitors to dislodge them once that buying habit is formed in a household. And this isn't just theoretical. This brand power is exactly why Nestle's weightage in the Nifty 50 index has been steadily evolving and strengthening from 2022 as we look out toward 2026. Keep this brand power in mind because it's the secret engine driving the crazy numbers we are about to see next. Section 3. Decoding stock valuation. Price versus value. Okay, so we understand the qualitative moats. Now, how does the market actually price those advantages? To figure that out, we need to quickly decode 2 critical metrics. The price to earnings, or PE ratio, tells us what investors are currently willing to pay for just 1 unit of a company's earnings. And the price to book value, or P to BV, compares the market's valuation to the company's literal accounting book value. Put them together, and they tell us if a stock is a total bargain, fairly priced, or carrying a really hefty premium. And this is where it gets really interesting. Just listen to the contrast between companies in the exact same index. Coal India, leaning heavily on its massive cost advantage moat, trades at a PE of just 9.06 times. It's a classic value play, offering a massive 6.04% dividend yield. But then, look at Nestle India. The market is happily paying a staggering 78 times PE for Nestle. No, really, nearly 78x. Why? Because the market inherently trusts Nestle's brand moat and believes deeply in its guaranteed future growth. And if you thought that was wild, the contrast is even crazier when we look at price to book value. ONGC, a massive oil and gas giant, is trading at a 0.97x P/BV. It's literally trading below its accounting book value, which screams undervalued. Nestle India, it trades at an astronomical 54 times P/BV, over 54x. And that absolute market trust, it shows up loud and clear in its stock price action, which has been bouncing around a very strong 52-week range of 1,085 to 1,510 rupees. Investors are paying this massive premium because they know Nestle's true worth lies in its brand and operational efficiency, not just the physical factories it owns. So the crucial point for us today is this. Looking at these extremes, you kind of have to ask yourself, which investor are you? Are you a growth-oriented investor, totally fine paying a high PE premium for exceptional efficiency and market leadership, like Nestle? Or are you a conservative, income-focused investor prioritizing high dividend yields and low PEBV, hunting for value in companies like Coal India or ONGC? The beauty of the Nifty 50 is that the whole spectrum is right there. Section 4. Champions of Corporate Efficiency, the Nestle Case Study. Let's funnel down even deeper now. Let's look at the actual internal profitability metrics that justify why on earth the market gives Nestle India these sky-high valuations. To do that, we use efficiency metrics. Return on equity, or ROE, tells us how efficiently a company uses its shareholders' equity to generate profits. Return on capital employed, or ROCE, goes one step further. It measures the overall profitability and efficiency and how a company utilizes literally all of its capital resources. Simply put, these numbers tell us exactly how good management is at turning the money they already have into more money. Okay, brace yourselves. Here is Nestle India's return on equity. 83.02%. That is a staggering number. In a world where, a 15 to 20% ROE is often considered very good, an 83% ROE demonstrates absolute market-leading management efficiency. For every bit of shareholder equity they hold, they're churning out an incredible amount of profit. And this isn't some lucky one-off here. It's the result of a relentless 5-year fundamental compounding journey. We're talking consistent sales growth of 11.64% and profit growth of 10.79% over that 5-year stretch. As if that wasn't enough, follow that up immediately with their return on capital employed, 95.66%. Almost 96%. This signals incredibly effective deployment of their total resources. Virtually every single rupee deployed by Nestle India is maximized for a return. They're running a remarkably tight, highly profitable ship over there. So here's where the whole thing clicks. This is where the micro connects perfectly back to the macro. It all starts with the qualitative side, that powerful brand moat. That moat is what allows Nestle to dictate premium pricing without people batting an eye. That premium pricing, mixed with brilliant management, is what generates that massive 95% ROCE efficiency. And finally, because the company is so insanely efficient, the broader market is more than happy to reward it with a 78x valuation premium within the Nifty 50. It's just a perfect, logical chain of corporate success. Section 5. Equity Market Outlook 2026. Pulling back out. All right. Pulling all the way back out to the macro view, let's look at what the experts predict for the broader Nifty 50 ecosystem as we navigate through 2026. The broader outlook remains quite constructive. To give you some perspective, HSBC Asset Management recently noted, and I quote, "With better earnings growth in FY27 and a potential trade deal with the US, we expect to see a return of foreign institutional investors into India." That sets up some very bullish fundamental drivers, especially since India's valuation premium relative to other emerging markets is finally back to its historical average. It's looking like a really attractive entry point for global capital. And when we look at the hard projections, the math looks highly compelling. Let's break down Kodak Neo's targets for the end of 2026. Their base case values the Nifty at a 20x PE on their FY28 earnings estimates, which brings their target to 29,120. If things get a little rocky, their bear case sits at 26,208. But, and this is a big but, if those bullish drivers we just mentioned fully materialize, we could very well be looking at a bull target of 32,032. Which brings us to our final thought. When you have top-tier Nifty giants like Nestle commanding absolute premium efficiency, and you have global capital poised to flood back into the Indian markets,
Are we actually looking at a 32,000 indexed reality by the end of 2026? It's a fascinating prospect, for sure, and one that makes tracking these macro to micro connections so incredibly vital. Thank you so much for joining me on this explainer. Keep your eyes on the data, and I'll catch you next time.